Welcome to Markets Now. I'm Michelle Rook along with Kent Beadle with Paradigm Futures, and we're lower except for the cattle market, which actually started off a little weaker but has rebounded. And Kent, we had kind of a risk-off week last week, lower weekly closes in all the grains, but especially a deep cut in wheat, and it looks like we're seeing some continued selling pressure there this morning. So the funds are continuing to liquidate here.
Yeah, they are. And a couple of things you need to look to. First of all, look at that stronger dollar. The outside markets are having some impact, and the strength that we've had in the dollar has a tendency to flow into wheat ideas first, because let's face it, we need to have wheat exports, and we're not doing particularly well in that front. I also think that the marketplace, with the upcoming negotiations around the opening of the Ukraine corridor, or the continuation of that Ukrainian corridor, is also having an impact. It feels to me like, even though the Russians are talking tough about whether or not they're going to allow that to continue, they have their own issues with needing to be able to use the Black Sea to export their own wheat crop, which, by their own reports, was fairly large last year. And so it makes sense that they would want to keep that corridor extended. Those are the main things that I
Right.
see. We did get some rain in the southern plains as well. That is a bearish input, although it's not something that we can trade every day, considering the fact that wheat is still in dormancy. Will be coming out soon. Crop ratings going into dormancy very, very low. And we're going to have to see a continuation of a good weather pattern if we're actually going to expect decent wheat yields this year. But that's for us to be trading here going forward.
What is the market sense, though, about the weather and the impact that it's had on the wheat? Because we're hearing of dust storms in Texas over the weekend, but yet, like you said, there were some rains that fell over the weekend. So is the perception in the mind of traders that this crop indeed is getting better?
Well, keep in mind, the traders, the grizzled veterans, so to speak, will always say that wheat has 9 lives, and we may have spent a few of them. But the most important thing about wheat yields is going to be what kind of weather do we have once the crop comes out of dormancy. So people take the current crop condition ratings with a bit of salt. They take current conditions with a bit of salt, and they're going to want to see what happens over the course of April and May, because that is going to be the key period of time for determining what our wheat yields are ultimately going to be in the southern plains.
You bet. So how much of corn's problem last week was just the fact that wheat was lower, or did we continue to see maybe some, at least psychological press here because of these outlook numbers?
Yeah, so I think the outlook numbers themselves were not bearish at all relative to expectations. I think the 91 million corn acres was a reasonable number, and I think it was a slightly smaller than what the trade had been anticipating. We did have reasonable upticks in both exports and especially in feed residual usage. And the feed residual number is something that I still think comes into play on the old crop corn as we get future stocks reports. I think the USDA is probably low, potentially by 100 or 200 million bushels. And so, we still have a lot of things to consider as we go with our old crop feed situation. But there's no doubt that with lower wheat prices, that had a pull down on the corn.
Right.
And I think that we also just had speculative liquidation. I think it was a risk off week because of outside markets, because of lower crude oil, and because of stronger dollar. All of those things had an impact on getting the funds to be selling commodities on a general basis.
Okay, we're into support areas in corn that we need to hold here, right?
We do. And if we don't, 2 things are going to happen. We're going to trigger some additional liquidation from the funds. And we're also going to give some bargain basement prices, I believe, to the end user industry, who I think ultimately will step in. You'll see basis levels get better. You'll see spreads tighten up. and ultimately that'll lead to a rebound. It's just a question of from what price, and with that is going to depend on whether or not we can hold the support.
Soybeans had a better week than corn or wheat last week, but we're seeing a little bit more pressure. And is that because of corn and wheat and what they're doing, or do you anticipate, some of this might be a little bit of Brazilian harvest pressure starting to come into the market?
Well, absolutely, and we have to keep in mind we are going to start shifting our soybean exports primarily out of South America, especially when we're considering Chinese destinations. We saw that in the inspections numbers this morning. They fell fairly precipitously, and it's about time for that to start happening. That being said, when we look at the domestic market, crush margins here as we go into first notice day in the March are $2.40 on the board crush. For May, they're about $2.10, still extraordinarily profitable. And unless you can get a more significant pullback in meal and oil, I think that the break in soybeans is likely going to find some pretty good support, especially at some of the lows that we've had, or the uptrend lines that are still out there keeping support underneath the market.
Cattle market initially seeing a little pressure on the opening, kind of fading the cattle on feed report and the bullishness there, but looks like there's enough folks that wanted to buy on the break here. We're back up, and that's kind of been the mentality of this market, hasn't it?
Yeah, it has. We haven't been surging higher, and the fundamentals are supportive, but it seems to be a slow go for higher markets in the cattle. We do have reasonable margins for the cattle producer, and every time we get into new highs, we do seem to find some hedge selling from that sector. I do like the cattle market still. I think fundamentally it has reasons for support. I think that we could ultimately see 168 to maybe 170 for nearbys, and maybe the summer months will be up into that 165, 167 area. But I'm also looking for this rally to be rewarded with, for my cattle guys, because it does provide some decent margin for them.
Yeah. And with lower corn, that's certainly going to help out here, this break that we've had. What about this hog market? A lot of us in the school have thought that, the bottoms are in here, but at the same time, another market that really doesn't seem to want to get up and go here. And where do you think we're headed in the market, especially since we do have those premiums in the back?
Yeah, well, we have a very strong seasonal, trend in higher pork prices from this point forward. And the cash markets are just not improving to the extent that I think that we had priced in. And so, that's why you now see a carry in the market, say from June hogs to July hogs, that it's kind of saying that we're not going to get to our peak quite as fast because we're not adding value to the cash as quickly as we thought that we might.
Is that because of the number situation being a little bigger than expected, or what, Kent?
Well, I think that's part of it. Although I am hearing from my cash sources that there's an awful lot of availability for barns, that that the cash situation may start to improve fairly soon. And so, what I'm looking at is support on these breaks. I do think that the lows were in, and I am expecting that we are going to be able to make some new highs in pork, although I don't know that we're going to exceed those contract highs by very much. I think those are probably the targets for hog producers.
Gotcha. Thanks so much as always, Kent Beadle with Paradigm Futures, joining us here with Markets Now.